I traded price action for many years. Same candlestick patterns you're probably using right now. Engulfing candles, pin bars, breaks and retests, and I was profitable with it. But when I added this one thing to my trading strategy, I genuinely wish I can go back in time, literally 9 years, just simply because the edge it gives you is something I just can't unsee. Now, while most traders wait for the candle to close when they enter, by that time, the moves typically already happened. And I'm not saying you're late because you're bad. You're late just simply because you're reading the wrong data. And today I'm going to show you the exact entry strategy I use every single morning on NQ, ES, even on gold that gets me in before the crowd. Let me show you. So the software I'm going to be using and going over today is going to be called Deep Charts. Now there will be a link down in the description, but Deep Charts is an order flow software that you can trade futures on and get order flow data. Now this is going to be a regular price action chart. This is going to be today's action here on NQ, which this is a real short position that I caught here on NQ because of this entry method that you guys could go ahead and literally click here and see on my second channel me taking this trade live and making $24,000 on this position. Now, the majority of times, if someone sees that price action is approaching a resistance range, they're going to wait for this engulfing candlestick to actually enter the position. Now, let's just say an average trader would have taken the entry right after that engulfing candlestick. And me, myself, I would have taken that entry after that engulfing candlestick if I traded the way I used to trade with my stop loss above that high. Now, this specific stop loss placement was at risk of actually getting stopped, but let's just for the sake of the video say, you know what, our stop loss is going to be here for about $975, and then I'm going to target this next level of previous support that we see here. Anybody using this type of entry signal is only going to get 2.5 R multiple out of this trade. While although yes, it is still a profitable trade if your stop was wide enough to not get waked out by this, what we can actually do is go a little bit more in depth and see what's going on behind the scenes. So all I'm simply going to do is head over to my indicators and I'm going to turn on this indicator called Deep Trades. Now, what this indicator is going to represent is this indicator is representing aggressive buying and aggressive selling in the markets. Now, the one thing I need you guys to understand and take into consideration is that you have two different types of participants in the markets. Passive participants that are going to be using limit orders to get executed into the market, and aggressive participants. Those participants are going to be using market execution orders to get executed into the market. Now, whenever somebody is buying or selling as an aggressive participant, they're using a market execution order. And that's what these bubbles that you guys see on my screen are. These are all aggressive buyers and sellers executing themselves into the market and putting themselves into a position. Now, the one thing I need you guys to understand, it is going to be the aggressive orders and the speed at which those orders come into the markets that are going to move the markets either up or down. Passive participants are going to be the ones that are absorbing that aggression or holding price in a specific area. So going over this example here, what we could see here is we have these green bubbles that are going to represent aggressive buying set at minimum 30 contracts or more. That is going to be considered a large buyer. And then we have the red bubbles that are going to represent large aggressive sellers in the market. So this is giving us a visual representation of where the real orders are being placed. Now, why this data is important, because if you're going to be looking for price to reverse and head in a specific direction, we can use this information to our advantage and get into the trade a lot earlier than somebody just waiting for a candlestick confirmation. And sometimes you might even avoid taking a specific loss by not taking a candlestick confirmation and waiting for these types of confirmations instead. So now the real question is, how do we use this information to our advantage? So going back into this example here, this is a trade that I took in real time. What we're going to be looking at here is this key level of resistance. Now you can see here 24,800 is going to be that resistance range. What I'm going to want to see are the buyers get absorbed. And what this simply means is that I want to see the buyers get aggressive as we push into this resistance range. So essentially, I want to see more green bubbles on my chart at this resistance range and price not follow through. Order flow really isn't something that is too complicated. It just takes a little bit of time to actually get used to. Really what order flow is you're looking at the data in real time and you're comparing effort versus result. we could see here that not only at the resistance level, there is much more green bubbles. Actually, there's no red bubbles at this resistance range, but much more green bubbles, showing us that the buyers are giving it a strong effort to push through that resistance range, but these buyers are not getting rewarded. So what this tells me, and we can also confirm this with other tools, which if you guys want to see how we could do that using a DOM or using a heat map, just drop a comment on this video and I'll make another video on that specifically. But what this shows me and tells me is that we have passive sellers absorbing this aggression in the market. So for every buyer, there has to be a seller. What's happening here specifically is every single time there is a large buyer executing himself into the market, there are sellers waiting on the order book at specific price levels, absorbing all of that aggression. The easiest way you can think about absorption is literally grab a bucket of water, grab a sponge, and put that sponge in the bucket of water, and you're going to see that sponge absorb all of that water around it. Absorption works in the same exact way. Now, when it comes to the entry specifically, the real question is, how do we enter the market here? Well, we already know one thing. We already know that this is going to be a main resistance level that we're going to be paying attention to for a reversal. But what we want to do is confirm the absorption, which we could see here on this candlestick. We could see at this very high, and at the high of the day, you can see how the buyers get aggressive, but yet there was no reward for those buyers, and we see a little bit of a sell-off. We then see price pop back up, and you can see the buyers yet again get aggressive. And at this point in time, when you see the buyers get absorbed again, meaning we see the buyers get aggressive and price starts to come back down. It's a little bit of a riskier entry, which I'll go over another different type of entry method that you can actually take on this type of move as well. Is once you see these buyers are getting absorbed and these buyers are not getting rewarded, meaning all this aggressive buying is not getting rewarded, price is either stuck or even falling down, which would make it worse for the buyers. This is where you would actually take your entry with your stop loss just slightly above that absorption point. Now, do you always have to keep the stop loss right at the absorption point? No, you could give it a little bit of wiggle room to breathe. And in this situation, I'm going to give you the exact stop that I use, which is the exact stop that I use, which is just above 24,820. And specifically because we also had sellers sitting on the order book at 24,820, which again, we can make another video on the DOM or on the heat map as well, so you guys can see good stop loss placement and real stop loss placement in the market. Now, that is going to be the entry here. So by the time somebody enters based off of this engulfing candlestick pattern, I mean, that person would have been 80% in drawdown. But by the time you entered the market, you can actually see that by the time the market falls to that person's entry, if you're trading the engulfing candlestick method, you're already going to be 112 ticks in profit. And what would have been a 2.5 R multiple trade now is a 7.8 R multiple position. Now, again, there's a few different ways you can actually trade this absorption reversal setup. You could wait for the absorption and maybe enter half of your position or start scaling into a position once you identify the absorption. You can also wait for aggressive sellers to start coming in. So we could see after the buyers got absorbed just slightly above this resistance range, aggressive sellers came into the market here. What you could do in this situation is wait for price to actually sell off and wait for price to start trading under and candlesticks to close under where these aggressive sellers came in originally that are initiating this move to the downside. That's what's going to be important here. We're looking for initiation. So number one, we have the confirmation of the buyers getting absorbed. This is a much more conservative entry. Number one, we have the confirmation of the buyers getting absorbed here. Number two, we have the second confirmation that the sellers are initiating a move to the downside. And all you want to see is a retest and rejection. So as soon as price comes back into this range here, as soon as price starts to reject this area, this is where you would take another short position. Now, the question is, how do we set our stops? Well, usually for me, I want to see the buyers I want to see the sellers in the situation continue to defend where they were getting aggressive. I wouldn't want to see price trading above it. I wouldn't want to see buyers getting back above that area again. So what I'm going to do is I'm going to set my stop loss above the actual candlestick that rejected, the wick that rejected where the sellers initiated a move to to the downside. And again, all we're doing is looking at where the aggression is coming in, where the bubbles are coming in essentially. And we could see here that on this type of entry, we were still able to get an 8.36R multiple. Now, really quick, before we get on to the rest of the video, if you guys want to trade these concepts live with me during the New York session, I trade ES and NQ Monday through Friday, me and my coaches. You guys can actually trade these sessions live with me, watch me take all of my trades, get mentored in real time, more importantly, and see my decision making in real time behind all of these positions. You guys click that very first link down in the description. I'll see you for the rest of the video. Even if you wanted to go a lot wider of a stop loss and say you wanted to put your stop loss above all of the trapped buying, you're still getting a 4.8R multiple on an entry method that is high in probability. And on top of that, you have much more confirmation on this entry method, and you're still getting double the R multiple compared to somebody just trading price action alone. Now, let's see how we actually could have avoided a potential loss, because if we were to even just look at this previous support range and just kind of scroll right a little bit here, this is why context matters, and seeing the picture of what's really going on is so important, because price pushed up into a resistance range here after a big sell-off. And we can very clearly see that there is an engulfing candlestick pattern. There's also a bearish variation, or an evening star if you want to call it. And most traders would have taken the short right here after this candle closed, probably looking for a move back down into whatever support range price made last. So let's just say you were going to target these lows. This is going to be a 3.7R multiple. R multiple is pretty solid there. But when we look at the context, and again, we look at effort versus reward, we could very clearly see that there was much more aggressive selling inside of this range compared to buying, which is not usually something that I want to see. Whenever I see aggressive selling enter the market, I want to see price reward that selling, and I want to see that selling continue to push the price lower, not pull back up and closes the doji. That's a whole different story. If this was aggressive buying that formed this doji, really great confirmation. But because this was aggressive selling, it's showing me that the intention to bring the price lower was there, but they didn't get rewarded. And it tells me the same exact thing that we saw just opposite on the previous example, that the sellers are now getting absorbed at higher prices. So the buyers are now defending price at a much more expensive premium. So we could see here again, buyer entered the market, buyer failed, buyer got absorbed, seller entered the market, and again, price closed bullish. This is not something I would be interested in looking to go short unless we saw a breakout to the downside, where then I would ride the momentum instead of taking that entry on the reversal. And you could very clearly see aggressive buying stepped in, that buying got rewarded, and price continued to push up from that point in time. Now, I'm not saying this as someone who never used candles before. Keep in mind, I've been trading for 9 years, and I've traded price action for all of those years. Engulfing candles, break and retest, support and resistance, literally all of it, and it works. I'm not saying it doesn't, and I was making money, but it always felt like there was something missing. It always felt like there was a little bit of guessing behind the actual pattern and the entry I would take. And honestly, sometimes when I would take an entry, I would just hope price goes into my favor because that's the pattern that I saw. But when I found order flow, that's when literally everything changed for me, and all of a sudden price action had real context behind it, other than just we bounced off of support. I could see why the engulfing candle was formed. I could see whether the breakout had real buyers behind it or whether it was about to be a failed breakout. And I didn't throw away price action, I just stopped being blind. And honestly, if I could go back and hand myself order flow from day one, I'd be years ahead of where I'm at right now. And this is just the tip of the iceberg. So if you're trading candle patterns right now and it's working okay, imagine what actually happens when you actually see what's going on behind those candles and you implement something like big trades indicators that show you real-time data. It's not a laggy indicator like a moving average, like an SMA, like a VWAP, but it's something that's showing you the data in real time and what's going on in real time. Imagine how much more powerful that would bring your edge up in the markets and your profitability more important. At the end of the day, as a trader, you always want to seek to improve, and even adding something as simple as a big trades indicator to your trading, it doesn't matter if you trade ICT, smart money concepts, support and resistance, just adding this will make you a 10 times better trader. I promise you that.